Good afternoon, everyone, and welcome to our second Mortgage Tax Strategist webinar. I am Dale DeGennaro, the immediate past president of CAMP, and we also have Alan Kane, who is our new CAMP Executive Director, Ruth Benjamin, who is our presenter today. I want to remind everyone about our summer camp Mortgage Expo, which is Thursday and Friday, July 23rd and 24th at the Hyatt Regency in Irvine this year. And I think Alan wants to mention a couple of things about it as well.
Oh, I just wanted to say that we went ahead and put a link for registration in the chat. It's a 2-day program. It's going to be lots of fun. There'll be more details to come. And then on May 21st, we have our 12th annual Lender Fair, which is in Thousand Oaks, California. And that's which camp chapter is that, Dale?
It's Ventura.
Ventura. So thank you, Ventura, for putting that on. We appreciate that. And we're going to hand the microphone over to Ruth Benjamin, who's your speaker today.
A couple other things I want to mention quick before we go to Ruth. Summer camp, there's some great speakers. We have AI in your origination, so there'll be some great, things you can implement. We've kind of set the whole thing up to be focused around origination, increasing your origination this year, and getting more proficient at every phase of that. We got a special panel, Best in the Business, and that's all it's several of the top producers from the Scotsman's Guide that gets published every year. We have the CEO of the MLO Branding Academy, the great expo that we always do, and much more. So we want to see you there Thursday and Friday, July 23rd and 24th down at the Hyatt Regency in Irvine. And today, if you sign up this next week, I have a special code for you. You can sign up for free. When you go to register, there'll be a question, do you have an access code? And you can write this down, CAMP, all capital letters, 26. If you put that access code in, it'll give you a free registration. So go ahead and exercise that. The website is there in the chat too, thecampsite.org. While you're there, you can scroll around and look at the membership. We have reduced the membership cost down to $150 for the year. And then you can join both CAMP and NAM, the National Association of Mortgage Brokers, for just $200 for a limited time. So with that, I want to thank Ruth so much for putting this class together and also presenting it all to us. So with that, I'll give it over to Ruth to take over. Thank you.
All right. Thank you, Dale. Thank you, Alan. And thank you, everybody, for being here with me today. We are going to talk about some stressful things, okay, that come up. So we're going to talk about trusts and asset protection and that type of thing. So I named my presentation One Loan Away, okay? And before I get started, again, my name is Ruth Benjamin. I have been you guys are looking at the wrong screen, I think. Let me try this again. Screen one. Okay, now you guys see One Loan Away. So I've been in the 1031 world for 35 years. So about 12 years ago is when I realized not everybody wants to continue owning real estate. They get a little tired of dealing with the tenants and the properties and that. So there's a lot of different ways to help get rid of the tax bill. I am located in Milpitas is where my office is at. I do a lot of work from home because it's more productive that way. But today we're going to talk about things that can really hit home. Okay. And so, like I said, I named this presentation One Loan Away. Now, how mortgage professionals can protect their personal assets from lawsuits. So, the reality of today's lending environment, what happens if a borrower sues you? An investor sues your brokerage? A compliance issue becomes personal. Now, most people, you close 8, 10, 15 loans a month, hundreds per year, thousands over your career. Now ask yourself, what happens if just one of those files become a lawsuit? So mortgage professionals operate in one of the most highly regulated industries in America. You have to deal with the federal lending laws, state lending laws, RESPA, TRID, fair lending, and everything else that comes with doing your job. Now, E&O insurance is critical, but your E&O insurance has limits. It has exclusions. It doesn't cover everything, and it may not cover intentional misrepresentation claims. It may not protect personal assets beyond limits, and insurance is your first line, but not your only line. So I'm going to give you a story today about Michael, a mortgage professional's wake-up call. So the day the process server walked in, it's a normal Tuesday morning. Pipelines to review, rate sheet updates, 3 pre-approvals waiting, 2 files in underwriting. Michael's reception walks back and says, "There's a man here asking for you. He doesn't say what it's about." So Michael steps out and the man asks, "Are you Michael Thompson?" He replies, "Yes." He says, "You've been served," and hands him an envelope. Michael opens that envelope. The plaintiff, it was a borrower from 18 months ago. He was a self-employed client. The allegation was, you did not properly explain the loan. You failed to disclose the risks. I didn't understand what I was signing. You put me in a loan I couldn't afford. Now here's what makes it dangerous. The market's shifted. Rates have adjusted. Payments have increased, and the borrower is struggling. And instead of accepting that markets change, they blame you. So the complaint claimed that Michael rushed the signing, that he didn't fully explain the adjustable rate structure. He didn't ensure comprehension. Now here's the reality. There were disclosures. There were signed documents. There were compliance forms. There were recorded acknowledgments. But when somebody struggles financially, memory shifts, and juries are emotional. This wasn't a random claim. Michael remembered that client. He had worked hard to close that deal. He believed he explained everything clearly, but now his name is on a lawsuit. Personally, not just the brokerage, him. That's when the fear sets in. Not about the file, about his house, his rentals, his brokerage profits, his kids' college funds. The lawsuit sought compensatory damages, punitive damages, and legal fees in the amount of $1.6 million. His E&O policy limit was $1 million, and defense costs were already eroding at that. Anything beyond policy limits, you have potential personal exposure. So the hard question is, what do I own personally? That night, Michael reviewed the equity he has in his primary residence and in his 2 rental properties, what was in his broker's retained earnings, his investment accounts, and he realized if a judgment pierced through that insurance, everything in his personal name was exposed. Now, many brokers believe my brokerage is in an LLC, I'm protected. But if you personally sign disclosures, if you personally guaranteed leases, and if you personally engaged in alleged conduct, you can be named individuals. In LLCs do not automatically protect you from personal liability. In fact, if you have 35 members or less in your LLC, you have exposure. So most brokerage owners personally guarantee the office lease, credit lines, warehouse agreements, software contracts. If the business gets hit, you may be exposed personally. So I'm going to talk today about our estate protector trust is what we call this, what I'm discussing today. So Michael had met with an estate planning attorney years earlier. He created an estate protector trust, not because he was being sued, but he understood his risks. So 5 years earlier, he had a proactive planning meeting. And the key point to this is the trust owned certain assets, not Michael personally. They were transferred before any litigation. If it was properly documented, the trust was properly funded, timing is everything. When the lawsuit hit, the plaintiff's attorney did a post-judgment discovery. It's a standard procedure every attorney does. They looked for where they could collect on this judgment, or on the lawsuit, I should say. And they look at his real estate ownership, they look at his investments and any cash in the bank. But the trust appears on the rentals, on his primary residence, and his investment accounts is all in the trust name, not his personal name. And the opposing counsel challenges it. But the trust was established years before any action came against Michael. No foreseeable claim at the time of funding. And funding with the trust means putting your home into it or just putting assets into the trust. The independent trustee functioned properly. Legal formalities were respected. So the leverage split, the separation equals negotiation powers. Now the plaintiff sees Michael does not own his assets personally. So the settlement dynamics change. Instead of a catastrophic liquidation of all Michael's assets, there was a structured resolution. Michael's assets were preserved. The tax reality is there are no trusts out there that are tax shelters. Trusts reach the top federal tax brackets very quickly. They hit the 37% tax bracket with as little as $15,000 of income into the trust. If the income stays inside the trust, it hits very quickly that 37%. So our trust is structured as a grantor trust for income tax purposes. It's a non-grantor for asset protection. So non-grantor trust for asset protection. So, but the tax reporting remains personal. So what happens is the income from the trust will flow through to your personal tax return. You still get the asset protection, but now you're going to be taxed at your personal tax rate. So you don't have to worry about that 37% tax bracket issue. So mortgage professionals with high income must coordinate tax and asset protection, plan it carefully. So common mortgage professional lawsuits, they're common with 1099 borrowers, business owners, rental income cases. When rates move quickly, borrowers look for someone to blame. So even unfounded claims are expensive to defend. Loan officers are even suing their brokers when it comes to compensation changes. When markets tighten, relationships strain, and litigation follows. So, what trusts can and cannot do? They can separate your ownership. It's the whole concept of you don't own anything, but you control everything. It protects against personal creditor claims and preserves long-term assets. What they cannot do, they cannot protect from fraudulent transfers. And what that means is if you get sued today and you get served today and you go, oh my gosh, I got to go protect my assets, and then you go and transfer your property to the trust, it's not going to help you. And I forgot to mention this in the beginning, you guys, in the chat, there is a quiz on what I'm talking about. But don't worry, as soon as we go through the whole presentation, we're going to go through the quiz together. Okay, so we're going to help you get through it. Don't worry about, what did did I miss something? Okay, we're going to walk you through the quiz, but it is something that we want you to fill out, and then you're going to send it back to me. So the people that have showed up last week's presentation and today's presentation can get a certificate for that attendance and have a designation given to you. So the designation is a MTS, Mortgage Tax Strategist. Okay. So again, what you cannot do with the trust is protect those fraudulent transfers. You've got to set things up in advance. It won't shield any criminal conduct. It doesn't eliminate tax obligations, but it doesn't always block certain government claims, which I'll dig into a little bit more further in the presentation. And it won't help against any child support or alimony claims. But it will take care of those, anybody that's trying to sue you, creditors, customers, those type of things. So the structure for broker owners, you want to have layered protection model, which is to have the proper corporate entity, okay? Have strong E&O coverage. Also have an umbrella insurance policy. Asset separation via trust created. It's not one solution, it's layered. And that's what we specialize in, is layering things, okay? So what's in your personal name right now? What is owned by your trust? Now remember, a revocable living trust, which most people have, the revocable living trust does not give you asset protection. It simply keeps you out of probate. Okay, so this trust would go alongside of your revocable living trust. So the legacy question, again, should one loan erase 15 years of production? You close hundreds of loans. It only takes one to go sideways. So you want to ask, what do I personally own? What are my policy limits? Have I reviewed my structure in the last 3 years, and is my family protected? And today I'm going to talk about 2 types of trusts out there that we offer. We call it doing well by doing good legacy preservation system. Okay. So for people that are worried about, getting sued, is your family protected? You want to make sure that assets get to your children and your grandchildren, right? And do you think you're immune from lawsuits because you have a corporation or an LLC? Did you know that the veil is pierced on LLCs and corporations 46% of the time? And like I touched on a little bit earlier, if you don't have 35 members or more in your existing LLC, you don't have the protection that you're expecting to have. So we have the solution that gives you the best asset protection available in the US without having to go offshore, and it provides powerful tax mitigation benefits. So the tax mitigation benefits we call our family holdings trust. Okay, so that's the heavy duty trust. Okay, and this is a non-grantor trust that provides the ironclad asset protection. We had a client sued back in the 90s from the state of Maryland. And that the state of Maryland sued our client 3 times over an 8-year period, and the state lost every time. He still owes on a $100,000 judgment that was created back in the 90s. I'm sure it's grown quite a bit since then, but he has 56 doors and has never touched a penny of that judgment that was supposed to be against him. He runs everything through his trust. So this trust is a contract between the grantor and the trustee. So the grantor, or they call them settlors in some cases, that's the person that applies for the EIN number. And then the trustee, which would typically be you. And this contract between the grantor and trustee says that if you're not a beneficiary of this trust, you don't receive benefits from the cash in this trust. So this trust can help you in the cases of bankruptcy. If your trust owns the assets and you don't, it will not get tied up in your bankruptcy. It's better than a prenup because I have daughters that have had properties that were owned before they got married. Well, if that spouse ever walked away, I don't want them losing their real estate over a spouse walking away. So if you get this set up before someone gets married, the trust owns the asset, then if a divorce happens, the trust owns the asset, not the wife or the husband that is getting divorced. So again, this is a non-grantor complex trust. It's the only entity that gets unlimited charitable contributions, and you get to deduct 100% of those contributions. And you get an additional year. So if you're filing your 2025 tax returns and you end up with a high tax bill and you show income in your trust, you can tell your CPA to say, hey, let's say it was 100,000 of taxable income. And you can tell your CPA, hey, put on there that I put $100,000 into a 501c3. Okay. And I have till December 31st of 2026 to get that donation in there. What happens if I don't get it in there? Then my CPA is going to have to amend my tax return. So there is no trust out there that can eliminate taxes by owning the trust. Okay, there's a lot of trust peddlers out there, and it's that trust that I'm talking about is 643 trust. That doesn't work. I've had it. I actually bought into it, found out from my CPA, no, I'm not going to file taxes on that. So we use IRS code section 642 that says you have to have a private family foundation to attain tax mitigation. So you can legally zero out your tax bill, and it allows you to choose how much you're going to pay the IRS. So we use this trust, it's our heavy duty family holdings trust, using this non-grantor trust to defer capital gains taxes for 30 years. It's a deferral method. This needs tax planning for the sale of real estate or a business or crypto or stocks. Okay, it works for everything. You need to be able to put the asset into the trust 2 years and a day before you sell. Okay. So when your non-grantor trust sells to a third party or after 2 years and a day, you can eliminate the tax on those gains for a total of 30 years from the date you put the property in the trust. So let me walk you through this. Okay. So if you have a property to sell, you literally sell it to your trust first today. Let's say it's $1 million. So you sell it to your trust on an installment contract, interest only for 30 years. Then after 2 years and a day, the trust can sell it to any buyer out there on the market. So if the trust sells the property for $1,100,000, now the trust bought the property for $1 million, but now it sells it for $1,100,000. So if you don't want to pay tax on that $100,000, you put the $100,000 in your own private family foundation that gets created for you when we create these trusts. Okay. The rules to the foundation is that 5% of the assets of the foundation per year must be given to a true charity, or you can put on your own charitable event. And then, so you put the 5% in, then the 95%, so it would be $95,000 of that $100,000. You can use that to purchase anything that's a passive investment. So most of our real estate investors, you can make your foundation a partner of buying an investment home, not a primary, not a second home, but an investment home. So if the foundation has, let's say, 30% down payment, the foundation can partner with you. The foundation can come in with all the cash. And then when the rent is paid on that property, the foundation would get 30% of the rent. You would get the 70%. So that's how you are growing your portfolio with using money that you typically would have given to the IRS. Okay. So you have to be careful with private family foundations. Your family, your parents, grandparents, they can't benefit from the foundation money. You can be paid trustees fees for running the foundation, but you really have to be careful once the money hits a foundation. There's so many restrictions to that. So who this works good for is anybody. Both of our trusts work great for anybody that owns a house or a business. How about elderly clients? If you have parents that might be going into homes to be taken care of, you might want to look at getting them into the home into a trust so it can't be touched. Now, remember, I don't know what the rules are anymore. I knew at one point they had a 5-year look back in that. So you got to learn those rules. But if you can get assets put into the trust, it's going to be protected. And primary residence works for the 30-year tax deferral, for the asset protection. There's a lot of ways to help people when it comes to those primary residents. So this type of trust typically runs anywhere from 15 to 25,000 for this huge trust. Now we have our estate protector trust. Okay, this trust is closer to 5,000, 4,997. This trust is going to give you all of the asset protection, but it doesn't give you the tax mitigation. The trust I just spoke about is generational. Okay, it gets handed down to your children. It just goes on forever. This trust, our estate protector trust, will die when you die. Okay, when the family, both husband and wife are gone. So again, this is our estate protector trust. It's irrevocable, discretionary. It has spendthrift provisions, and it is an intentionally defective grantor trust, which means you have the asset protection, but it's a grantor trust as far as the income, so it can hit your personal tax return. So it has the very strong asset protection needed. And let's say that you didn't know which one you wanted to start with. So you do this one for $4,997, and then you think, you know what? I want to use it for some tax mitigation. You can always upgrade to the higher trust, and we credit the 5,000 that you paid to go into the higher one. So you're not going to pay twice, but we want to get most people started in their asset protection so that you're covered. And then if you want to use the tax mitigation part, we can always look at that. So the first step is to have a family member or a close friend be the settler of your trust. That person applies for the EIN number, and be assured there's no liability to the settler. So once the trust is signed and the settler signs it and has it notarized that they're removing themselves from the trust, they can never come back and claim your assets. Okay, they irrevocably remove themselves from the trust. So once you get it and you put your assets into it, they can't come back and say that they own any of those assets. So almost 100% of our clients, 99.9%, are the trustee of the trust. So you're the one that's going to have the legal ownership. Beneficiaries, They have no ownership rights, but they are beneficiaries. And all of the trust assets are separated from your personal estate. So why creditors have limited access? They have no demand rights. Beneficiaries cannot compel distributions. Interest cannot be pledged or transferred, and the spendthrift clause blocks creditors from attaching your assets. The trustee may suspend payments during the litigation process, and creditors cannot force access to your trust assets. So the trustee, which is typically you, is empowered to act decisively when threats emerge, controlling the timing from the terms of all distributions. The trustee has strategic flexibility during active litigation or creditor pressure. So again, there's two really important parties to this trust. One is the settlor, the one who applies for the EIN number, so the government doesn't even know you own this trust, okay? Two is a trust advisor. The trust advisor is somebody that's going to run your trust. You're going to ask them to add and remove beneficiaries, buy and sell properties. But you, as the trustee, have 100% authority to fire the trust advisor if they're not doing what you're asking them to do. So it's a very simple process, just a form that fires them and you bring in somebody else, okay? But that's where your asset protection comes in. You didn't apply for the EIN number and you're not controlling the trust. Okay, somebody else is, but you have the authority to get rid of that somebody else if they're not listening. So this trust cannot be undone or amended by the settlor. The settlor is not a beneficiary, and this trust minimizes court exposure and discourages claims. So if you get one of those envelopes, you hand them what we call a certification of the trust, and you'll find that you'll be negotiating in a different manner. So what this means practically, when properly funded and administered, you will have no personal ownership. Assets are legally titled to your trust. The lawsuit pressure does not automatically reach trust assets. Beneficiaries cannot compel the trustee to distribute income. The trustee controls the timing. The distributions are made at the trustee's sole direction. So if somebody says, I know the name of your trust, and they sue it, fine. The trust is a contract, and that contract says if you're not a beneficiary of this trust, you're not going to get any money from this trust, okay? So don't let anybody frighten you that they know the name of your trust. Now, typically, people may name the trust their family name, which is fine. But when I set up my trust, my husband and I used our favorite song, and that's what we ended up naming it. So the bottom line, the estate protector trust separates the ownership from control, creating layered protection against creditors, lawsuits, and beneficiary claims. Its irrevocable structure gives you permanent legal separation. You, the trustee, holds the full authority, and we cannot stop people from suing you and getting a judgment. But if that happens, the judgment cannot be enforced because you don't own anything. You just control everything. And again, if somebody sues your trust, they won't be able to get to that your assets. Okay. So asset protection is not about avoiding responsibility. It's about preventing catastrophic loss from one event. So protect what you built. Now I'm going to touch real quick. I know I'm running a little longer than normal here, but we are going to go over the test. But I want to show you a little bit about other options when you're for tax strategies. So typically when someone gets on a call with me, and let me tell you in advance, any of the trust, any of the tax strategies that I show you today, everything except for 1031 exchange can earn referral fees. Okay. So if you got on a call with me, I would ask, this is just a prior client that had a property he sold for 915,000. He bought it for 280. He had $310,000 mortgage. He bought it in 2013 and he put $80,000 of improvements. He lives in California and the property's in California. Why is this important? If you're in California and you own a Texas property that has zero state tax, California still wants their 13.3%. So you're not getting out of taxes by owning property in a tax-free state. So in this case, the original cost basis is 280,000. The mortgage balance is 310. So that creates a debt over basis, or people call it mortgage over basis. And when that happens, when they pulled the money out of this property, if they didn't use it to improve this actual property, they could get taxed up to 39.6% on the difference. So in this case, there's a $30,000 difference. They would have an additional $11,880 tax bill. So I'm just going to touch real quickly. We have strategies to eliminate 99% of the tax bill, defer the tax for 30 years. People that own real estate, there's investments you can go into that can help you also get cash. The basic delayed exchange, we have reverse exchange, we have improvement exchange, we have a lazy 1031 exchange, and then our trust could work if you did 2 years from now, and charitable remainder trust. That's before the sale. After the sale, there's another 10 strategies: charitable lead trust, charitable gift financing. There's leveraged charitable opportunity zones, convertible tax bonds, battery energy, tiny homes, equipment leasing, oil and gas drilling funds, AI data centers, and airplanes. So as you can tell, there's lots of things to do. Don't ever tell somebody that they can't get rid of their tax bill. But this is how you can reach out to me, or if you reach out to Don Crozier, he also can get connected with me. He's the one that brought me in. But now we have about 10 minutes, so I'm going to ask you guys if you have any questions, then I'm going to answer those, and we're going to go over the test. So I'm going to stop sharing so I can see the chat, or Alan or Dale, tell me if you can see any questions.
Will do. Thank you so much for that presentation.
It's a little overwhelming, but there's lots of information to talk about. Okay, so many small investors do not have their businesses set up properly, and their CPAs are not much help. So much exposure. I agree 100%. Can you buy and sell through the estate protector trust? Absolutely. Irrevocable trusts make refinances very hard. Any thoughts on how to address that? Thank you for asking that question. Absolutely. We do just like the revocable living trust. You can deed out, do what you got to do, and deed back in. That's not an issue here. So will we get access to both of the presentation slides? Yeah, I think that should be okay. So Helen, when can I take the first class? You guys are going to make it, we have it recorded, so you guys decide when and how that's going to happen. So let's go over the test. Okay, we've got 10 minutes for that, and you guys put your questions in or raise your hand or however you guys want to do it for questions. But let's go with number one. What industry are mortgage professionals considered to be in? The answer is B, high liability industry. Okay. Number two, which of the following can create personal exposure? The answer is all of the above. D as in dog, all of the above for number two. Number three, what does E&O insurance stand for? The answer is B, B as in boy. Number four, what was the settlement demand in the story? Answer is C as in cat, $1.6 million. So true or false? Having an LLC always protects you from being personally named in a lawsuit. The answer is false. Number six, which of the following commonly requires a personal guarantee? The answer is D, all of the above. Number 7, what is the primary purpose of the estate protector trust? The answer is C, as in cat, separate ownership from personal exposure. Number 8, trusts are C, subject to compressed tax rates. But remember, so the heavy duty trust I talked about hit that 37% rate because it wants to help with tax benefits. If you use the estate protector trust for the 4,997, then you don't have that issue. Okay. So number 8 is C. Number 9, in a grantor trust strategy, income is B as in boy, flows to the personal tax return. Number 10, which is a common mortgage broker lawsuit? The answer is D, all of the above. Number 11, true or false? Trust can protect fraudulent transfers. The answer is false. Fraudulent is after the lawsuit has started or you have knowledge of a lawsuit. Can't help with that. You've got to get them set up in advance. Number 12, which is part of a layered protection model? The answer is D, all of the above. And in a properly structured irrevocable trust, who holds legal title? The answer is C, the trustee, which is you. Number 14, why do creditors have limited access to trust assets? The answer is D, all of the above. And the last but not least, number 15, complete this statement. Insurance protects your file. Structure protects your future. Okay, did anybody miss any of those? Did you get it, Alan? All right.
1 and 2.
1 and 2. Number 1 is B as in boy. Number 2 is D as in dog, all of the above. And somebody else said number 15. 15 is file and future. Number 9, B as in boy, flows to the personal tax return. 4 is 6, yeah, 1.6 million is correct. For number 4 is C. Number 6 is D, all of the above. And then I need to give you guys my email address. So I'll put Ruth Benjamin. Okay, so I gave you my email address. So we're going to ask everybody to send in your quiz and let me know that you participated through the whole thing. And if you did participate all the way to the end, you got all the answers to the quiz, right? So you should have those. Do we print them and email back? You can either save it as a file, you say your quiz, and then you can email it. So you can do it either way. Print, scan, email, or just save it. After you fill it in, save it, and then email that to me. Okay, waiting until after this event, I think. Can you briefly review test 1 from last week? I'm not sure if we can get you the results for it for that. Number 5 is false. And where is the email? It's in the chat right here. Let me see. Oh, Alan keeps putting it in. So, oh, where did mine go? Somewhere else? Maybe mine went to panelists. I don't know. Oh, it's up here. It's up here. So you guys can get that. Okay, anybody? Any other
Hit
questions?
number 5, I think. Brianna wanted
Oh,
number 5.
number 5 is false. And then how do we watch class one? Alan, you're going to determine how that happens. I get that the non-grantor complex trust versus estate protector trust are different. How do you work with a client with a mess of investments? All right. The key is to get on a call with me. There's no charge for the call. We're going to get on with you and your client, and we're going to talk about everything that they have, where they want to be, and I'm going to help you guide that client to the best situation for them. Least amount of taxes, asset protection. If we were late to the meeting today, does that mean we did not participate all the way through? Let's let Dale and Alan decide on that one.
Let's pretend like we weren't asked the question.
Okay, some
Made it to the end of the meeting.
somebody's asking for the quiz.
We just resent it.
Oh, you sent it in again. Okay. What is number 3? 3 is B as in boy, errors and omission.
Dale, do you have the coupon code for the event?
Camp 26.
So CAMP capitals CAMP 26, it sounds like.
Yeah.
Correct.
Thank you, sir.
Okay. Thanks, Ruth. Very informative. Thank you, Marge. Okay. Camp 26. All right, so what I'm hoping you guys got out of the last 2 weeks of classes is there's many ways you can help your clients. You might not have a loan at the moment, but you've got clients that depend on you. They trust you, and you can help them in many ways. Okay, Bonnie says that she loves this. You guys, your education series. Looking forward to learning more. What is the minimum net worth needed? There really is no minimum. I mean, 4,997 to set up a trust. If you own more than 4,997 worth of assets, you should think about getting into the trust. Or, you just don't want to get sued, right? You don't want to have a judgment on you before you set up a trust. So, what we do is we typically take $2,500 down, and then once the trust is done and the attorneys reviewed it, and it's coming to you for signature, then you pay the balance. If you have anybody that's interested in a trust and says, well, I don't have that all in one lump sum, will you take payments? We're open. We are really interested in helping people get that asset protection. Okay, do we get the designation sent to us, or what happens after we submit this second test? I'll be working with Dale, Ellen, and Don Crozier as far as getting those certificates out to you guys. Under the estate protector irrevocable trust, the settlor is a family member. I can be the trustee. Can I be the beneficiary also? No, you don't want to be a beneficiary and a trustee. But in some cases, the husband stays the trustee and the wife is a beneficiary. It just depends on what type of control you want. So that's why we really have to structure it to somebody's needs. And when I said, as far as the settlor, the one who applies for the EIN number, typically people use their parents or brother and sister, because if they pass away, their parents or brother or sister usually don't get anything out of the estate. It goes to the family. But we can work on different people to choose. Some people use their best friend, or, but we can always work on the best person to choose for that. Okay. 15 is file and future. Yes. Do you assist the client with tying together their living trust with these asset protection trusts? Yes, absolutely. Would you meet with a family that could utilize your family foundation trust, but they don't speak good English? Would you need consultation in person? We can do it on Zoom. I just need somebody that speaks English to make sure they understand what we're talking about. Do you do consumer seminars that we can offer to our clients? Yes, we can. All right, we did good on time, I think. Right? Yeah. We're right in line.
Say perfect.
We
Better
tried
than good.
we tried to stay in the timeline. We didn't want to ask you guys for all this drawn out you get on a webinar and sometimes it's like, okay, are they going to finish? We did it. Oh, what is the answer to number 8? Is C, subject to compressed tax brackets.
Look at everyone helping each other too as those
I
questions.
know, you guys
That's
are
awesome.
great.
We're all part of the team here.
It's all good. I enjoy working with all you guys.
All right, everybody.
Alan, how many people did we have on in this one?
64 at the end. I think we peaked at around low 70s. So again, very high retention.
Yes.
Whatever you're doing it
Good job,
well.
guys.
Excellent. Don't forget about our 2 events that are coming up. Summer camp, July 23rd and 24th. That's in Irvine this year at the Hyatt. And then the Ventura chapter, that's May 21st. And both are free. The Ventura, you can just register and you're free at that one. And summer camp, you have to have the code camp 26, all capital letters. So
You
keep
guys,
that
that's
in
not
mind.
hard to remember. It's the year we're in, 26.
If anybody's near Danville, California tonight, which is in Contra Costa County, we do have a mixer out there. I'm not sure if that's for public information. If so, I'm in trouble. But if not, I'm in trouble. I mean, but information.
Absolutely, everybody's welcome. That's at the Auburn, and it will be at 5:30. It's our East Bay Mortgage Mixer.
All right, somebody's asking for number 3. Is B as in boy? Number 7, C as in cat. Oh, we have how do I join camp? Go ahead, you guys.
Thecampsite.org. So thecampsite.org. And just click on membership and you can sign up right there. Again, the new memberships have been lowered to just $150 for camp only. And you can join camp and NAM for just $200 for a limited time, which is a great deal. Never been cheaper, actually, either one.
So somebody's asking about putting their name on the test. If you email it from your name, I'll know who it belongs to, but otherwise, yes, feel free to put your name on the test. So did you see the question, does San Diego have a chapter?
Yes.
Okay. All right. How do we fill out the answers? Print and scan. You can print and scan, or you can save the document, fill it out, save the document, and then email it to me. Somebody says they don't see the test.
You could probably print it out, fill it out, and maybe take a picture of it and email it as well, correct? To make it even easier.
Yeah, Kyle says he's highlighting and bolding the answers. Perfect. Highlight and bold the answer, and yet that's answering it. Somebody says they were 5 to 10 minutes late and want to make sure. Yeah, we have recorded it. Alan, they want to know your email. Okay, everybody's asking how they get the first class. So, do you guys have a thought on that?
It'll be on YouTube. We were waiting for today to be complete. So either later today or tomorrow, we'll post both on YouTube. And if you'd like to revisit Quiz 1, you can email Ruth or I, and we'll send you a copy of Quiz 1. In fact, I'll just put it in the chat right now as we speak.
Yeah, take the quiz now off of the chat and then watch the video. No. We went through the same thing. We gave the answers at the end, so you can